Chapter 4, Part 1. We're first going to look at accounting changes, discontinued operations, and other comprehensive income. Now, what are accounting changes? Well, we have actually a total of 4. The first are changes in accounting principle, changes in accounting estimate, and change in reporting entity. But we also have correction of an error, which is treated the same as a change in accounting principle. Now, change in accounting principle refers to a change from one acceptable accounting method to another. So, if you were doing one method that was not acceptable and you changed to another one, that would be considered an error. So, again, you have to go from one acceptable method to another. If they're mandated changes in accounting principles, usually from the FASB, there are 3 approaches and they decide. Retrospective means you've got to change prior periods, usually the last 3 years, because that's what shows up on the financial statements. The modified retrospective approach means that you only have to adjust beginning retained earnings of the current year. And prospective approach is we only go forward and it's only implemented in the current year. Now, we also have voluntary changes. These are ones that a company decides they want to do. Normally, it's a change in inventory method. These are accounted for retrospectively by revising prior year's financial statements. Again, an example would be a change in accounting costing method. Now, changes in depreciation, amortization, and depletion methods. These are considered a change in accounting estimate achieved by a change in accounting principle, which means, well, what does that really mean? It means that we only look at prospectively. We do not go back and change. An example would be if you had a piece of equipment that you thought would last 10 years, but it turns out now it's going to last 15 years, you would only look at net equipment, and then we use that as a basis of coming up for the remaining years. So, it is treated the same as a change in accounting estimate. The only difference is that you have to have a footnote that justifies the change. Now, change in estimate. Change is due to modification of estimate as the new information arrives. An example would be accounts receipt allowance for doubtfuls. Now, you notice based on COVID and what's been going on, probably companies had to change these estimates. What do we estimate? We estimate our warranty reserve. We estimate returns. We estimate how much we're going to have to write off in accounts receivable. These are only accounted for prospectively. Now, if the effect of the change is material, we have to have a disclosure note and show its effect on both the income statement and earnings per share. Now, prior period adjustments, these are usually errors. That's what we're talking. And we're talking about material errors that have not self-corrected. These require that the company record a journal entry that adjusts any balance sheet accounts to their appropriate levels and show the effects on beginning retained earnings, and you would need a disclosure note. Now, another thing we have is discontinued operations. Now, what is that? Well, if a company decides to sell or dispose of a component of their business, profits from these discontinued operations, the minute they decide that they're going to do that, has to be set aside and shown separately net of tax. A component of an entity or group of components has been sold, disposed of, or is considered held for sale. That's the definition of a discontinued operation. Or disposal represents a strategic shift that has or will result in a major effect on a company's operations and financial results. Income or loss from discontinued operations is reported separately below income from continuing operations. Now let's take a look at an example. Mike had income for the year of $1 million. The company sold one of its operating division, which qualified under GAAP as a separate component, which means it would be a discontinued operation. The before-tax loss on disposal was $340, and the division generated before-tax income of $500. The company also incurred $8,000 in restructuring costs. That means they let people go, move people around. And we have to assume a 25% tax rate. So what's that going to look like? We first start with our beginning income. We adjust for restructuring costs because these are always shown pre-tax. Then we take out our tax, and now everything below that is going to be net of tax, which includes our discontinued operation. And normally we'll have two components. One would be any income or loss that's generated, and then any amount, gain or loss on disposal of the net assets. And these are always shown net of tax. And in this case, we had a gain, and that would be net income. Now, what if we had other items that are not part of normal transactions? And these are specifically designed. They would be part of other comprehensive income. So, you have to remember you have net income, and then you have other comprehensive income, which is also shown net of tax. Now, examples. There are a few gains or losses that are not reported in the income statement. These other gains or losses are reported as other comprehensive income. They include net unrealized. Now, what is unrealized? It means you've adjusted fair market value and you haven't sold them. So you can have gain or losses, and it usually is associated with available for sale securities. You have gain or losses from post-retirement benefit plans, and deferred gain or losses from derivatives and foreign currency translation adjustments. So now let's take a look at an example. Now, we had net income for operations. We have a 25% tax rate. So, one of the factories was closed and restructuring costs were $1.2 million. This is going to be shown pre-tax as part of operating income. Disposal of an operating division that qualifies under GAAP as a component that incurred losses of $500, and assets were sold for a gain of $1.4 million. These would be part of discontinued operations and are shown net of tax. Investments were sold at a loss of $220,000. In addition, there were unrealized gains of $320,000 on long-term investments. The loss on sale would be part of other, shown pre-tax, and the unrealized gain would be part of other comprehensive income, shown net of tax. It was discovered that depreciation in the previous year was understated by $200,000. This would be an adjustment to beginning retained earnings and treated as a prior period adjustment. And then we had negative foreign currency translation adjustment. This would be also part of other comprehensive income shown net of tax. So now let's take a look at what that all looks like. So we start with income from operations. We take away our restructuring costs. Then we do other, which is the loss on sale of investments. That means we've actually sold the investments. Then we take out a tax, and this gives you income from continuing operations. Then we do our discontinued operations. We take our loss and our gain, and we take the total times the tax rate, and that tells us in this case we had a gain in total from discontinued operations, net of tax. Now we have net income. Now we're going to do other comprehensive income. Here we have unrealized gain, which would be net of tax. We have foreign currency translation loss, also net of tax. That gives us total other comprehensive income of $60,000, which gives us total comprehensive income of $4,770,000. Now, sometimes what companies do is They will show net income on one statement, and then they'll have a statement that follows that shows other comprehensive income and total comprehensive income. I think they do it because they want to look better. So that ends this presentation.